Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss trading system illusion Martingale.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will discuss Martingale and we will discuss how is the Martingale betting system used to fool people out of the money and how this is one of the most common ways that are used in forex scams and scam robots on the internet. The current video is based on the article The Art of Financial Illusion, how to use Martingale betting systems to fool people. I really recommend you this paper. It's a paper from Carlo Zaratini and Andrew Ezis that can be easily downloadable from SSRN. So what is that paper about? The internet, especially part related to finance, trading and cryptocurrencies, can be dangerous, and it's full of offers of guaranteed returns, pictures of forever growing bank accounts, and guys with golden rings swimming in a bathtub filled with the cash. But the truth is usually less rosy. The internet is full of scams. One of the oldest concepts from the beginnings of the conceptualist probability and statistics is Martingale, and is very often used to lure inexperienced new traders who are then eaten alive by marketing sharks. How does it work? Right? The idea is simple. So what is the Martingale? The Martingale is a betting strategy that shows you or tells you that every time you have a losing trade, you should double down and invest or trade twice the money that you used before that. When you try to run that, you can very easily bankrupt your account, because first time you bet $1, the second time $2, the second time or the third time $4, then 8, 16, etc. And after 10 losses, you would have to bet 1,000 times the initial amount of the bet. So there is like no account that will be able to handle that when you start with some normal betting money. So when you start to bet like, $100 or something like that per trade. So sooner or later there will be a string of losses, and after the string of losses your account will go bankrupt. So there is a lot of the theory around the Martingale on Wikipedia. There's a lot of the articles that will try to explain that using the Martingale is not a good proposition, but there are still people who try to use the Martingale to build trading strategies, and that they try to sell it to a lot of the other peoples. So what is their business plan? So their business plan is simple. Of course, when we run the Martingale, we have like very high probability that sooner or later our account will go bankrupt. But let's imagine that you are the scammer and you would like to have a business plan. So you would like to build out of sample trading account or out of sample trading performance. You want to have 1 year trading performance with a 20% annual return. How you do that? How do you build a track record with the Martingale? So it's very easy. So what you will do simply is you will open 10 accounts. So you will open 10 accounts, you will put small amount of the money into each of the account, and then you will run the Martingale on each of the account. Of course, some of the accounts will end up with the horrible losses. So you will have like 80% drawdown or 55% drawdown. You will lost all of the money. But some of the accounts will have like significant positive return, because simply by sheer luck you will be able to get the desired 20% return with the small drawdowns and small volatility. So you will discard all of the other accounts. You will leave just the account that had the high performance with a nice Sharpe ratio and nice equity curve. And you will show this track record. This will look like this, and you will show this track record to all of the unsuspected potential customers, and you will market your extremely well-performing trading bot, and you will try to sell it to all of the other. Of course, afterward, your trading bot doesn't have any edge, so doesn't have any chance to earn any money, but you will still get an annual management fee of 1% and performance fee of 25%, for example. The money you will get from the marketing, it will give you a possibility to open another account in which you can once again for the next year run some random Martingale signals on all of the other accounts, and for the next year select another account and once again show nice performing curve. And you can repeat and repeat and repeat. And basically that's how a lot of the forex robots and cryptocurrency robots work. That's their business model. It's good to be aware of that, and it's good to not pay for something like that. So if you would like to know more about it, if you would like to deep down into the mathematics, if you would like to deep down into how does it work, I really recommend this paper. I also recommend to read our quick overview of the article on our Quantpedia webpage. If you are interested into all of the quantitative finance stuff, all of the quantitative trading, algorithmic trading, etc., and in real knowledge, please give us like and follow us at our YouTube channel or Facebook, on LinkedIn or Twitter. So thank you very much, and I hope that you will join me in the next video.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.